Alright, cool. Welcome back. This is deux, part on deux, part uno, dos, part dos of the basics. So last video, what we basically talked about was kind of pips. No, sorry, was what Forex is, what pairs are, what sessions are, and I kind of explained what major, minor, and exotic pairs, what they are, and the characteristics of them. I'm so fucking tired, bro. I said I would record part 1 and part 2 back to back, but you can see the background's probably darker. I came back from the gym. I need a shower. I need to eat. I'm tired, bruh. But let's fucking get it. Let's get it. So, obviously, we talked about what Forex is, pairs, sessions, and I explained minors, majors, and exotics, right? In this video, we're going to get into the language of trading. So we're going to talk about pips, we're talking about spreads, we're talking about costs, and we're talking about different types of orders you can place in the market. So let's not waste any time. I need my shower, bruh. So let's start. So pips. I've said pips a lot. What is a pip? A pip is short for point in price. A pip is measured as, in fact, point in price, and it's the smallest unit of a currency. So remember how in the last video we used the example of GBP USD, and we said that for every £1 it equates to $1.35, right? Or actually, this is a simplified Google Basic Ask version of the exchange rate. In reality, look at it. I'm on GU right now. Look at it on where my mouse is in the gold. It's actually 1.34636 or 7, slowly going up and down. So that's the actual price of GBP USD, the pound against the US dollar. That's the actual price. You see how small the kind of price changes are? This is why we use pips. So 1 pip is defined as 0.0001 of a currency. So that means that 10 pips is 0.001. That means that 100 pips is 0.01 of a currency. So cool. This is a little cheat sheet you can write down for pips. But generally you need to know that 1 pip is 0.0001 of a currency. And let's get into a little example of what this actually means. So let's use what the real price data are here. So let's say USD is currently 1.3346. We'll say 00 for a little bit of simplistic sake. We'll say it's that, right? Now let's say price goes higher, right, to 1.34610. That means price is increased by 1 pip, because 1 pip is 0.0001. So how many positions away from decimal point? 1, 2, 3, 4. That 4th position, 1, 2, 3, 4, has increased by 1. So this is a change of 1 pip. Cool. What if it was this? This is a change of 10 pips, because that 3rd position after the decimal place, which is 6, has increased by 1 to 7. So that is 10 pips. What if it increased to this? Sorry, that's the original. What if it increased to this? This is 12 pips. Why? Because this shit increased by 1, which is 10 pips. This shit increased by 2, which is equal to 1 pip. 10 plus 2 is 12. It increased by 12 pips. Cool. Another example. What if it increased to this? This has increased by, tell me, 100 pips. I was waiting for you to tell me. Anyway, it increased by 100 pips. Why? Because 100 pips is 0.01. 0.014 has changed to a 5. 4, difference of 4 and 5, 1. This second position equal to 100. 100 pips. 100 pips. Cool. So that kind of, hopefully you can understand what a pip is. And I'm going to explain why we use pips. So pips, they're very small. It's the smallest unit of a currency. And with exchange rates in general, mate, say you go to an airport, you're going to see that they're increasing and decreasing at very small rates. So it might increase by a pip or a few every seconds. They're increasing by very, very small kind of numbers, right? And what a pip is, it basically is a term that traders use to kind of quantify that small change in price, or that small unit of price. And it's very general in the trading space. Everyone knows what a pip is. So yeah, hopefully that explains why we use pips, because price changes very small. So we need a term, instead of saying, oh, price has moved 0.001 units, we say price has moved 1 pip, price has moved 10 pips, price has moved 15 pips. So hopefully that explains that. All right. Next, let's look at what spread is. So spread, I've used this a lot in, hopefully you wrote it down in your notes, but a spread is basically difference between the bid and ask price. Cool. So basically, remember in part 1, I said you can either buy or you can either sell. Those are the two options you sorry, I just had a notification. Bro, 1 second. All right, cool. So when a spread is the difference between the bid and the ask price. When you're buying, you get shown a bid price. When you're selling, you get shown an ask price. Spread is the difference between that price of when you're buying and selling. So let's say, in fact, you just know that. And then with that, we kind of quantify it in terms of pips. So you might have a spread of 2 pips. You might have a spread of 5 pips, 1 pip. And what that means is that if you buy with a spread of 1 pip, that means you're going to get automatically placed 1 pip at a loss of 1 pip. So say you enter where price is currently here, you might get filled a bit higher. That's what that means. And we'll kind of look into the types of orders you can get filled into, the types of orders you can place. But another thing you need to understand is why spreads are tighter in majors versus then minors and exotics. So the last video we looked at majors, minors, and exotics. Basically, the further you go down this list, the more you're going to get fucked in terms of spread. Spreads are fucking bad. Spreads mean you're not going to get placed where price currently is in reality. If you're buying, you're going to get placed higher. If you're selling, you're going to get placed lower, which is bad because that's bad. We don't want, if we're buying, and price is here, we don't want to get placed here, meaning we have to wait till price comes up to here till we make a profit. We don't want that. Spreads are fucking bad. They fuck you over, and brokers, they charge you a spread to make money off you. So basically, when you get filled, say like here, when price is here, you need to move a few pips to be in profit, and then brokers, what they do, they actually profit off that little movement. They fucking fuck people over, bro. Long story short, you need to know that spreads equal the difference between bid and ask price. Cool. So majors, they have tighter spreads. Tighter spreads are fucking good because you're gonna get filled closer to where price actually is. The reason why majors have tighter spreads is because they have large liquidity and less volatility compared to minors and exotics. Because of this, what this kind of means is that you see how price is moving. It's very calm. So if I want to enter right here, I'm probably going to get entered right here. Versus with exotics and minors, they move fucking up, down, up, down, up, down, up, down. So if I enter like here, I don't know if I'm going to get entered here. I don't know if I'm going to get entered here. You're going to get charged a higher spread. Cool. And sometimes spreads, they can go in your favor, but most likely they go out of your favor. Yeah. No, spreads, they always go out of your favor, sorry. Spreads, they fuck you over, they're bad. Cool. Cool, so let's look at the different types of orders you can actually place in the market. So one, you have market execution. Two, you have limit orders, and these can be buy or sell limit. And then you have stop orders. And these can be buy and sell. Cool. So for market execution, also known as instant execution, if you're buying, say when price is here currently, you're gonna get filled instantly. You're gonna get into the market instantly where price is. And this doesn't take into account spreads. The broker might charge you a spread. I don't know, I'm not taking that into account. But market execution, generally, you're gonna get filled instantly into the market. You wanna get in the market as soon as possible. Cool. For limit orders and stop orders, they're known as pending orders. So you're gonna get filled in the future. So it's an order where price is waiting to get hit, then it's gonna trigger and get you into the market. So you see how it differs from market execution or instant execution. With market execution, you're instantly in the market. With limit orders and stop orders, you've got to kind of wait until price hits your level, then you're in. Cool, so let's explain what limit orders are. Limit orders, you can have buy limit or sell limit. For a buy limit, say price is here, or we'll use the screen right now. Price is where the gold line is. If I place a limit order or buy limit, buy limits, they can only be placed below where price currently is. So I can only place buy limits from here to below here, right? And then once price, say I place a limit here, buy limit here, 1.34492. Once price, you see the gold line, reaches this level, I've then entered into a buy. So then I'm anticipating that price will then increase. When we place a sell limit, you can only place sell limits above where price is. So say I place a sell limit where my mouse is here. You see in the gray, 1.3551. Once price, the gold line, gets to here, boom, I'm entered into a sell position. So I'm anticipating that from here, this level, price is going to go down. Cool, that covers limit orders, buys and sell. For stop orders, it's kind of the opposite of limit orders. So for stop orders, so for buy stops, you can only place buy stops above where price currently is. So say I place it here, a buy stop here, 1.34540. Once price gets to this level, the gold line, I'm anticipating that price will go further up with a buy stop. Cool. And then with a sell stop, you can probably guess by now. So if I place it at this level, once it gets to here, the gold line, from here, I'm anticipating that price will go continue further down. And you see why limit orders and stop orders, they are pending. They're called pending orders because we're waiting until price reaches that level. Whereas market execution, we enter how big of a position we want to enter, which we'll get into later. We enter it, boom, we're in. Limit orders, stop orders, we enter our position, but we select a future price. And once price hits that future price, boom, we're either into a limit order or a stop order. So that kind of covers types of, or order types. Next, we're going to get into trading styles. So your trading style generically has to match your personality. If, for example, you're an impatient guy, intraday trading is not going to be for you. Let's get into what like the types of trading styles are, because what's the point of me explaining when you don't even know? So one, we have scalping. Scalping is short, it's fast. Me personally, I'm saying it's stressful. And spreads, they fucking hit you the hardest. I remember when we were talking about pips, right? In scalping, you are trading a few pips. You might be trading like a price, price that changed 10 pips and you're wanting to profit off that. Scalping is short, it's fast, it's stressful. And because you're trading such small pips or, small, small pips, when you do get hit by spread, it's gonna fucking hit you, bro. It's gonna kill you. So that kind of explains what scalping is. Two, you have intraday. Intraday is what I fucking do and I fucking love it, bruh. So basically the trades within your day. I intradayed and I fucking love intradaying, man. Intraday trading. Like, I could be in a trade, I'm hoping to anticipate, a move of like maybe 50 pips, which is pretty big comparing to scalping when you're maybe trying to profit off 10 pips. So it's kind of not stress free, but it's more chill, I'm more relaxed. I'm in trades for up to, a few hours. Quickest trade I've had is probably like half an hour. So I'm in the trade maybe for most of the day. Whereas scalping, you're in the trade, bro. I know some scalpers, they're fucking in and out, bro. And they've either made 2K or they've lost $1,000. Bro, it doesn't make sense. I mean, they're making bread, so Depends what type of guy you are. This is why I said you need to make it match your personality. Me personally, I'm biased. I cannot do that shit, bro. All right, number 3, swing trading. These are trades which last multiple days. And generically, you have less screen time. So a swing trader will probably be in a trade for, maybe a few days to maybe a few weeks at most. And you can kind of guess the screen time is going to be less. Whereas I'm on my screen looking for trades every day, Monday to Friday, depending on what news is saying. We'll get into news later. Swing traders, they will place a trade maybe on a Monday. They won't check that trade, or they won't, either lose or win that trade until 5 Mondays after that Monday they place the trade. So like 5 weeks. That's a bit of a stretch. We'll say a week. So yeah, multi-days, you're in trades for like multiple days, weeks at most. Less screen time, less stressful potentially, but it depends on your personality. 4, we have position trading. Position trading is just long-term investing, literally. Like, them guys that got rich off Bitcoin, they were position traders. They hold positions for up to like months, multiple weeks, potentially even years, bro. That's all I can say for position trading. Long-term investment, long-term investing. And what you'll quickly, I'm biased, right? I've learned intraday trading, so I'm obviously going to impose intraday trading onto you. However, you do need to know kind of all 4, because as I said again, it's the bread and butter of trading. It's the language of trading. You can't be a trader and hear the word scalping and not know what the fuck it means. You're going to be in a trading space called a dumbass, called someone that knows nothing. So we need to know what this is. And who knows, like, although I'm an intraday trader, intraday trading fits my psychology really well. I have minimal stress. But who knows, like, maybe you finish this boot camp or the standard and you find out you want to do swing trading, or you find out you want to do scalping. Who knows? We all have different personalities, and whatever fits your psychology at the end of the standard the best, you do you. But obviously I'm biased with intraday trading. It fits me well, so I'm going to impose intraday trading onto you throughout the series. So that kind of covers up the basics. These are like the basics. Like, these are shit that you should just know, and this is why I'm teaching this. So hopefully you know what pips are. Hopefully you know what spreads are, different types of order types, trading styles, basically how, when you place a trade, what's actually going on. So cool. I think that kind of sums up the fundamentals you need to know before you just step onto the charts, before you start learning concepts. And obviously the concepts we'll get into are still very basic, but this shit is like, there's basic and then there's bruh. This is bruh. But next we'll get into the basic concepts that you can implement in trading. So cool. I'll catch you guys in the next video. Peace.